I put the same $70,000 into real estate and into the stock market. 30 years later, one of them turned that $70,000 into $1.22 million. The other one, after all the costs most people never calculate, turned it into $870,000. The one that won might not be the one you think, and the margin between them will completely change how you think about the biggest financial decision most Americans ever make. Most people never see this comparison done honestly. The real estate side always leaves out the costs. The stock market side always leaves out the behavior gap. I've watched both sides of this debate for 30 years, and I've never once seen someone put the same dollars into both paths, run them to the same finish line, and show you the real number on each side without an agenda attached. That changes right now. And if you've been trying to figure out which path is right for your situation, the next 20 minutes might be the most valuable thing you watch this year. Hit subscribe before we go further. I run this kind of analysis every day, and the algorithm genuinely buries it if you don't tell it you want it. Here's what you're going to know by the end of this video. The exact 30-year math on both paths with the same starting capital. The specific hidden costs that real estate investors almost never account for, and what they actually do to your real return. The one number that determines which asset wins for your specific situation. And the single most expensive mistake people make when they choose wrong. Not because the asset failed them, but because they didn't understand what they were actually buying. Let's start with the real estate path. You take $70,000 and put it down on a $350,000 single-family rental property. Columbus, Ohio, Charlotte, North Carolina, San Antonio, Texas, solid rental markets, real places, real numbers. Your mortgage on the remaining $280,000 at today's investment property rate of around 7% runs approximately $1,863 a month. You rent it for $2,200 a month. On paper, you're positive $337 a month. That's the pitch. That's where every real estate seminar ends. But here's what most people miss. That $337 evaporates before it ever reaches your pocket. Property taxes on a $350,000 home average 1.1% annually. That's $3,850 a year. Insurance runs another $2,200. Maintenance, roofs, HVAC systems, water heaters, plumbing, averages 1 to 1.5% of property value annually when you hold for 30 years. That's another $3,500 to $5,000 a year. Vacancy, single-family rentals sit empty roughly 6% of the year on average. On a $2,200 rent, that's $1,584 in lost income annually. Add it up. Taxes, insurance, maintenance, vacancy. That's $11,000 to $12,600 a year in costs sitting on top of your mortgage. Your $337 monthly surplus just became an $800 monthly deficit. You're writing a check every single month to own this asset. That's the number the appreciation chart never shows you. Meet David. He's 38, works in supply chain management in Dallas, makes $85,000 a year. 3 years ago, he bought a $350,000 rental property with $70,000 down. He ran the numbers the way most people run them. Rental income minus mortgage equals profit. He was showing $340 a month positive. He thought he'd cracked it. Last year, he sat down and added everything up for the first time. 12 months of property taxes. 2 insurance payments after his insurer raised rates. 1 HVAC repair in August that cost $4,200. 6 weeks of vacancy when his tenant moved out. His actual cash position for the year was negative $8,400. He didn't lose his property. But he didn't make money either. He paid $8,400 out of pocket to own an asset that appreciated on paper. That's the real estate experience most people are actually having right now, and nobody posts that on Instagram. But here's where I have to stop and be honest about something. Because if I just showed you those costs and declared stocks the winner, I'd be doing the exact same thing the real estate pitch does. Hiding the number that changes the argument. Because David's property didn't just sit there, it went up in value. And the way it went up, is the reason intelligent people choose real estate and not because they're wrong. David put down $70,000, but he's controlling $350,000 in appreciating assets. Residential real estate in the United States has appreciated at 4.3% annually on average going back to 1975, according to FHFA data through 2026. 4.3% of $350,000 is $15,050 in year one. That is a 21.5% return on David's $70,000. Not 4.3%. 21.5%. On the same capital, because the bank's $280,000 is appreciating alongside his $70,000, and he only put in $70,000. That is leverage. That is the entire real estate argument in one number. And it is real. So let's run the full 30 years on David's property. Appreciating at 4.3% annually, his $350,000 property is worth approximately $1.26 million at year 30. Mortgage paid off. He owns it free and clear. $1.26 million in equity. That's the number people post. But David spent $11,000 to $12,000 a year holding that asset for 30 years. That's $330,000 to $360,000 in carrying costs that never appear in the appreciation chart. His real net equity position after costs is closer to $870,000 to $900,000. Still a serious number. Still genuine wealth. But not $1.26 million. And we haven't counted the time he spent managing it, the stress of the $4,200 August repair, or the 3 weeks every year where he's chasing a new tenant. Now the stock market path. Same $70,000, same David, same 30 years. Except this time he opens a brokerage account, buys a total market index fund, sets up dividend reinvestment, and does almost nothing else for 3 decades. The S&P 500 has returned 10.4% annually on average over the last 100 years with dividends reinvested, using a conservative 10% to keep the math honest. $70,000 at 10% for 30 years. No maintenance calls, no vacancy, no insurance bills, no tenants calling about the HVAC in August. The number at year 30 is approximately $1.22 million. From doing almost nothing. I'm not done yet. Because that comparison, $870,000 for real estate versus $1.22 million for stocks on the same capital, is the number nobody puts on the same slide. The no-work path beat the active path by $350,000 on identical starting capital, over identical time. And the stock market did it without a single midnight call about a burst pipe. That is the honest comparison. That is the math both sides hide from you. But here's what the stock market pitch always leaves out. That 10% return is what the index earned. It is not what the average investor earned. Dalbar's 2025 Quantitative Analysis of Investor Behavior, the most rigorous tracking of actual investor returns in the industry, found that over the 20-year period ending December 2024, the average equity investor earned 9.24% annually, while the S&P 500 returned 10.35%. That gap doesn't sound large. On $70,000 over 30 years, the difference between 9.24% and 10.35% is approximately $350,000 in lost terminal wealth. Gone. Not from a bad fund, not from bad luck, from panic selling when the market dropped 30%, from moving into cash in March 2020, from chasing the hot sector after it already ran. The investor who earned 10% and the investor who earned 9.24% owned the exact same fund. One left it alone, the other didn't. That behavioral gap is the hidden cost on the stock market side, and it is just as real as David's $4,200 HVAC bill. Now here is the number that actually determines which path wins for you. It's not your income, it's not your net worth, it's not your age. It's this: How many hours a month are you genuinely willing to spend managing an investment actively and doing it well? Not planning to, not hoping to, actually willing. Because a rental property managed with discipline, bought in the right market, held through downturns without forced selling, with full cost accounting from day one, that asset can produce outcomes the stock market genuinely cannot replicate at the same starting capital. The leverage is that powerful. David's path to $870,000 net was the bad version of real estate. An investor who bought in Austin in 2013 managed costs professionally, held through the 2020 uncertainty, and sold in 2023 cleared numbers that no index fund could have matched on the same capital. That happened. It was real, but it required knowledge, time, discipline, and a specific market that was fundamentally strong. Remove any one of those four things and the math stops working. Remove two of them and you're David writing $8,400 checks and wondering what went wrong. The stock market path requires almost none of that. It requires one decision, executed once, automated, and then the most underrated skill in personal finance, leaving it alone when every headline tells you to do something. If you can do that, $70,000 becomes $1.22 million in 30 years without a single phone call to a tenant. If you can't do that, if you sold in March 2020, if you moved to cash in 2022, if you're going to chase the next hot sector, you will not earn 10%. You will earn closer to 9%, and you will spend 30 years wondering why the math didn't work the way the chart said it would. Here are 3 things to do right now. Not general advice. Specific actions. First, calculate your real hourly commitment. Before you put $1 into real estate, write down the honest number of hours per month you will spend on it. Then multiply that by what your time is genuinely worth. If your time is worth $50 an hour and property management takes 10 hours a month, that's $500 a month, $6,000 a year, $180,000 over 30 years. Add that to your carrying cost calculation and see if the net return still beats the index fund. For most first-time landlords running their own properties at current mortgage rates, it does not. Second, if you're already in the stock market, pull 5 years of statements and calculate your actual return. Not the return the fund earned. What you actually earned, including every time you moved money. Compare it to the S&P 500 total return over the same period. If you're trailing by more than 1% annually, you don't have an investment problem. You have a behavior problem. The fix is not a new fund. The fix is a written rule that you do not touch the account during market declines. Write it down before the next decline happens. The decision your current self makes on paper today is the one that survives. The decision your future self makes while watching the market fall 35% almost never goes the right way. Third, if you're choosing between the two paths right now, answer this question honestly before you decide. Have you ever held any investment through a 30% decline without selling? If the answer is no, if 2022 made you nervous, if March 2020 made you move to cash, if you've ever panic sold anything, real estate's leverage will not save you. It will amplify the same behavior that already cost you money in stocks. The asset is different. The behavioral requirement is identical. People don't fail at real estate because the property went down. They fail because they couldn't hold through the pressure. They don't fail at stocks because the index went down. They fail for the same reason. Here is what I want you to carry out of this video. 2 assets. Same $70,000. 30 years. Real estate net of costs produced $870,000. The stock market at the index return produced $1.22 million. The stock market at the average investor return, what most people actually earn, produced closer to $900,000. They're almost identical when you account for what real investors actually do with both assets under real conditions. The honest answer to real estate versus stocks is not which asset is better. It's which one you will execute correctly for 30 years without getting in your own way. And here is the fact I want you to sit with after this video ends. According to the Federal Reserve's most recent survey of consumer finances, the typical American homeowner has a net worth of $430,000. The typical renter has a net worth of $10,000, 43 times the wealth. Not because real estate always beats stocks, because a mortgage forces you to build equity every single month, whether you think about it or not. While the renter spent 30 years paying someone else's mortgage, while the person who opened the brokerage account and never automated it spent 30 years meaning to invest and never quite getting around to it. The best investment is not the one that wins on a spreadsheet, it's the one you will actually execute. For 30 years. Without stopping. The investors who built real wealth in both assets didn't find a secret. They found a system they could stick to, and they stuck to it while everyone around them was looking for something better.